Someone wants to know, what do the wealthy do differently with taxes that most people miss?
It's hard to give one answer to that, but the vast majority of wealthy people build wealth in a business or in real estate, one of those two, mostly business. So real estate is a great way to keep money. It's harder to build money unless you're really active with it. Some people have been successful at it, but it's great on defense. For offense, business building your own business is number one by far in all cases. There's a quasi in between thing like with tech companies. If you're like employee number six at some startup that becomes real successful, you can build a lot of wealth that way. And then when it comes to the planning, once you're at that level, there are different things that open up. There's any number of what I call the exotics strategies, and I call them that just because they require stuff outside yourself. So there's planning within your personal tax situation. There's planning within your own business that you 100% control. And then there's planning where, okay, we have to bring in this insurance guy and we got to do this, that, and the other, and it's going to cost 50 grand in fees. And that's some of the stuff that becomes available once your income is high enough, which they all work, but not all of them. Most of them work, but they are complicated. They take a lot of compliance work, and it's a big to do. And the numbers involved there generally start at 50 to $100,000 worth of out of pocket costs. So it only makes sense once you're in like half a million, million and up, which very few people are. But by and large, the best way to build wealth in a tax efficient manner is to build up long term capital gains. And the most effective way to do that, assuming you're successful, is in your own business. So I'm hardcore on entrepreneurship to do that. And then there are strategies that you can employ on the sale part to reduce taxes. Then you can sell to an employee stock purchase plan. You can do a 1202 exclusion. There's all different kinds of things that you can do at that point to mitigate the tax impact there. But as you're building your own business, the equity that you're building in the company as far as brand value is not taxed at all. You're building an intangible asset in the brand equity. In fact, I was just having a discussion on Twitter about intangible assets and how they're accounted for and all this kind of stuff. So that's the most cost effective way uh, to get to that wealthy point where it's like, okay, now I have a sale and I make 5 million, 10 million, whatever dollars at that point, and it's taxed preferentially because it's long-term capital gains. And then there are these other things that I can layer on top that can potentially cut that down even more. So like under 1202 exclusion, you could potentially sell your business for $10 million and pay $0 in taxes,
Wow.
at least federally. Some states will file that simple, but that's extremely powerful if you can get it to work. There are conditions. Like everything, there are conditions. Um, Failing that, if you're not in business for yourself or your business doesn't grow to that level, then just investing on your own into long-term assets like stocks or real estate or whatever, and then either not selling them or selling them in a tax efficient way, like with real estate, you can do a 1031 exchange. That is going to be a really powerful way to build wealth and either not pay tax or defer tax or mitigate it in some form or fashion. Um, people like to jump on Jeff Bezos or pick your favorite billionaire to hate and say, so and so didn't pay taxes. It's like, yeah, because what they did was they borrowed against their stock as collateral, and a loan to you is not income, right? Because you got to pay back. And just so happens that the way they pay back is they borrow some more money from some more stock, right? So they just keep that process going. And as long as the company or the asset is worth more and more, then that works just fine. And then you have your buy, borrow, die approach, where eventually you pass away and then your heirs get a step up in basis and everything gets reset at that point. But you're gone by that point anyway, so it doesn't matter. So yeah, So there are some things that are different in terms of those exotics that wealthier people have access to. They can buy into certain investments, certain syndications, and things like that is not available to people underneath a certain wealth or income threshold. But by and large, the things they do are similar. They're just larger scale. So investing in their own business, investing in their own portfolio, whether it's real estate or equities or bonds or what have you, and then just being smart about how they tap the value of those things so that they can do it in a tax advantage way. And in fact, the discussion Serena and I were just having a couple hours ago with a client, he was talking about uh, the impact of taxes on wealth growth. And
Mhm.
taxes are an enormous drag on wealth building because the average employee might pay 0% in federal income tax, but they're still paying 15.3% in payroll tax. And they'll say, well, the employer pays half, but not really, because it's total cost of employment to the employer. So they're paying 15% in FICA, Social Security, and Medicare tax. And it's like, what would have happened to their financial lives if they got that 15% instead? And then they were able to invest that over time and have that compound. It's an enormous difference over a working career. But that's if they were to actually take that money and build something with it rather than just consuming it through just spending that has no residual value. When it comes to personal finance stuff, it's all personal. It's very little finance, to be honest. It's, you got to be you got to be the type of person who can defer gratification. And one of the things I've learned over the years is that building wealth is very simple. It's not easy, but it's very simple, and just requires you to go against every human instinct you have. If we go back to caveman days, it didn't make any sense to put something to work that would take 5 years, 10 years, 20 years to pay off because your survival demands were more immediate than that. Maybe you save for the winter, maybe, right? By and large, if you hunted a mammoth or whatever, you ate it then. That's just it. The ability to defer consumption when you have the ability to take it now is very hard to resist. And if you can't do that, then no plan is going to work unless you just get lucky. Your lottery winners and all that kind of stuff. But even they go broke because there is no amount of money you can't spend. So it has to become, you have to develop those personal habits in order to develop that base of wealth that grows over time. And then once you're there, then there's other strategies to employ. I hope that made sense. It was a little bit far afield.
Yeah, makes sense to me.